Hi, Frank and Madeline. Welcome back to our meeting, and I wanted to go through the section of your second most important goal that you had indicated that you wanted to cover through our financial planning process here, and that was to pay off the home mortgage loan by the time Frank is 55 or 20 years from today. And so I have in this section here of the plan options on how to accomplish that. And so we'll go through each of those options, and then I'll give the recommendation that I have on what the best option would be given what all we've put together here. And so you'll see the list of assumptions that we have here, including what the current rates are for refinancing in different terms, and then also with the costs to do so, which you have indicated you want to pay outside of the mortgage loan. You don't want to build that into the loan itself. You would pay that out in cash. Then what your property taxes are currently. Then also you'll see in the assumptions that I am not including the gift that was on the income statement for this past year. I'm treating that as a one-time occurrence, not knowing whether or not that is something that is given annually. We do know that the salary that Frank receives and the self-employment income have been consistently coming in each year, and so for mortgage underwriting purposes, seeing the consistent income in can verify in that debt to income calculation that's done. So if we move to the first option here that I've proposed here, and that is paying extra on the current loan principal. And you'll see here that with the current loan being in place for 6 years or 72 months, you can see that you've paid almost $109,000 in interest, a little over $15,500 in principal, and there's still $225,000, a little over $225,000 remaining in the balance. And that if you were to continue to pay as scheduled over that 30-year term, you would pay over $380,000 in interest. And I know that's some shocking figures there, but this is the power of compounding interest when you borrow money and spread it out over that significant time period. The majority of the interest that's earned on the loan is paid out in the beginning, and the principal is a minor amount and then begins to grow as the term goes. So the opportunity to take a look at paying it off early will show significant savings in what the interest that is paid out on that loan amount over that shorter time period. And so what I have proposed in this first option here is that you pay an additional $127 per month starting now. The loan would be paid off in that 20-year time frame as you're desiring, and that there would be a savings of over $54,000 in interest from the 30-year schedule by merely paying that additional $127 a month and ending it 10 years from what you had scheduled. The monthly payment amount would be a little over $1,500 annually more than what you're currently paying, but the increase on your housing cost ratio would be quite minimal. It would be changing from just 12.9 to 13.7, and well within the underwriting guidelines that we typically see for approval for loans on refinance of mortgages. So that 28% range is typically what we want to stay in, at 28% or below in that figure. The second option that I've placed out here is to go ahead and refinance the balance into a new 20-year mortgage loan. And so using those assumptions that we've made, you'll notice that there is not a specific rate for the 20-year mortgage loan, that in fact the break points are you have the 30-year fixed rate mortgage loan rate offer, and then it jumps down to the 15-year fixed rate loan. There is no break point for 20, so the 20-year mortgage loan rate would be the same as the 30-year. So anything between 15 to 30 gets that rate, and then at 15 years or below is the lower interest rate from that. So using those assumptions, if we were to go in and refinance, that fixed rate would be at 7.5% versus your 7.75%, but we are then amortizing in a much shorter period from that 30 years down to 20. What happens there is that your monthly payment would end up going up to $1,813 per month, higher than your current one by a little over $1,000 annually, but only a slight increase in that housing cost ratio from 12.9 to 13.5%. Less than the principal paydown payment option we showed in option 1, well within that 28% range that we talked about. Total of $210,000 in interest will be paid in this refinance option. When adding to that current amount of interest of the $108,692 that you've paid during these first 6 years or 72 months, and then that additional refinance cost that we'd add in as well, which is 3% of your mortgage refinance amount, or $6,750. We add all those together. That cost, a total of $325,464, ends up being $54,000, just a little under $55,000 less than the current mortgage loan, and a greater savings than option 1 that we've shown. The third option would be getting more aggressive in the pay down on this, so actually going, instead of a 20-year, down to a 15-year fixed mortgage loan rate. The rate drops quite a bit to 7% rather than that 7.5%. Your monthly payment would jump up quite a bit, and jump up to a little over $2,000 a month. That ends up being, over an annualized basis, a little over $3,500 a month, or annually, that's paid on that. It does increase the housing cost ratio from 12.9 to 14.9%. But again, we're still well within that range of 28% or less. The big difference you'll see here is that a total of $139,000 of interest would be paid in this refinance option. When you add that to your current amount of interest paid in those refinance costs, your total cost of borrowing the money for this home is a little over $254,000. That would be $125,775 less than the current mortgage loan, and significantly greater savings over that period of time. One more option I'm going to show is that there's an opportunity to pay down the mortgage balance with a one-time lump sum amount in order to accelerate the loan payoff to that desired 20-year remaining period. I've included, along with the other pay down on the monthly basis, I've included a chart and worksheet summary from Old National Bank's internet website loan tools page that illustrates the schedule when you apply a lump sum down. Again, I've also given this schedule on that $127 a month payment option in that option 1. But this one would be, in fact, that you were to pay down a one-time amount of $15,250 on the principal balance. The loan would be paid off in that 20-year period. There would be a savings of almost $68,000 in interest charges. The monthly payment would end up remaining the same. So all we've done here is that we've shortened the amortization period. This is an option that's typically one time. If it's over 10% of the mortgage loan balance, there's usually little to no cost related to doing so. It's one of those kind of hidden benefits in the mortgage loan contracts that you have. So one of the things we would want to do is to take a look to see if in fact it states that option, or make contact if in fact that were something that you all wanted to consider. You may ask then where this money would come from in order to do that. Part of this option would give consideration of the potential inheritance that Madeline is receiving, and that from the estate settlements of her parents, and that we would utilize some of those funds, if they are in the form of cash. We would use $15,250 of that to go ahead and do that option. With all of them that's presented, my recommendation would be to refinance into that new 15-year refinance with the lower rate and the lower term. The costs are significant. The impact on the ratios are minimal. You are paying that higher loan amount, but your cash flows show that you have that ability to go ahead and pay that extra amount each month. One of the things that we would need to take a look at in consideration is if in fact a new appraisal's required, even though the one is just 6 months old. Many times even in a refinance, they'll require a new appraisal. If in fact the home were to appraise higher, that would be a good thing, because the fact that the current amount of that $225,000 versus the appraised amount of $275,000, that is a loan to value of a little over 80%. It's not at the 80% or less level, and because of that, you would be likely to have private mortgage insurance that would be there for a period of time until the loan balance was below that 80%. And so my recommendation would be, if in fact that 81.8% loan to value stays because the appraisal's used, the current one, or in fact a new one did not go up any higher than that, then I would recommend that we pay that balance down in cash by $5,000 to the $220,000 mark, and refinancing the amount of $220,000, which would be then 80% of that $275,000 from that. So that would be my recommendation, so that you don't have that PMI cost. Thank you.